last week we had the Buffett measure that said things were nuts. We got a trailing PE measure that was very high. Then we had our forward PE, much higher than anything we've ever seen. And we got the CAPE, the cyclically adjusted. On all these measures, things are either crazy expensive or they're expensive. Hello, welcome to this episode of Rich Insights. I'm Don Rich, head of investments for Esoterica Capital Markets. Today's topic is PE ratios. PE ratios are probably the most common valuation metric. Right? Is it cheap? Are things cheap? Are they expensive? Well, there's a lot of different ways to look at that, but PEs are probably the most common. And it's price per share divided by earnings per share. That's why it's probably so common. It's very simple to interpret. Right? Today, we have a PE ratio of 20. So that simply says that people are willing to pay $20 today for each dollar of current earnings. Is that expensive? That's what we want to tear apart. Now, on top of PE ratios, which is going to be a number of them, we're going to walk through different ones today. A trailing PE, a forward PE, some called a cyclically adjusted PE. We're going to look at all of those. There's also some people take a PE ratio and flip it over. Instead of P divided by E, it's E divided by P, right? And it's called the earnings yield. So we see these measures, these metrics, used in a lot of different contexts to determine valuation, to justify whether or not something's expensive or cheap. Now, before we go ahead and get started with today's analysis, let's remember last week we looked at another valuation ratio. It's called the Buffett valuation metric, something that Warren Buffett made popular. That compared the value of Main Street to Wall Street, and we saw that was at all-time highs. It was even more expensive, right? Today's environment is even more expensive than the dot-com era. Things were nuts during the dot-com era. For those of you that were in the game back then, you can remember how nuts things were then. Well, we have surpassed that level of stupidity. Now, the stuff we're going to look at today, nothing is above the dot-com. All right. The general rule of thumb is it's going to be the same conclusion, though, boys and girls. Damn near everything looks expensive. Doesn't matter how you slice and dice this, just like it did with the Buffett measure. But it's not at all-time highs. Okay. So let's go ahead and jump right in. So we're going to start with something called the trailing PE ratio. That's the current price today divided by the last 12 months worth of earnings. All right, the trailing 12 months worth of earnings. All right, and now we have our our black dotted line here. All right, I use that in a number of my charts to let me know what the last observation was. And you can see here we're just shy of 20 right now. Just shy of 20 for the S&P 500. Now, is that expensive? Well, you can see we've had some periods of time where we traded above that, right? But not many. Not many. If we go all the way back to the 1950s, the PE is averaged, let's call it 16 and a half. All right, that's this brown line here. The long-term average was 16 and a half. So 20 should get you concerned. It should get you concerned, right? There's just not a whole lot of time we've been trading above this black dotted line. All right, 20 should start to get you concerned. Now let's rub some salt in that wound. We're in the middle of a recession, folks. If we go back and look at previous recessions, we've never had a PE above 15. And we're at 20? Oh my gosh, are we expensive. All right, so if we consider the fact that we are in a recession today and we've never seen a PE above 15, you say, oh shit, fat guy. Things are real expensive right now. All right, that's on a trailing PE basis. But who's to say that the last 12 months of earnings are going to be reflective of the coming 12 months worth of earnings? Right? We don't know what the future holds for sure, but we go to the second chart here. It's called the forward PE ratio. So what we're going to do here is the numerator, the price is still the price, the current price. But what we're going to do is use analyst estimates for the denominator. What do analysts think earnings are going to be in the 12 months coming? Okay, so on a trailing basis, the S&P was at 20. On a forward basis, it's at 23. All right, you can see the black line here. It was just shy of 23. All right, and you can also see we're in the 100th percentile. All right, this chart only goes back to 2003, but we're at the most expensive level by far, folks, than we've ever seen in recent history. Now, this chart not only has the S&P 500, it also has some of the other indices, some of the most popular indices throughout the world. And what you can see here is everything is either trading at its all-time highs or very near to it. So it's not only the S&P, it's not only the U.S. markets that are nuts right now. It is global. It is global. All right, the other thing I want to point out from this chart is you'll frequently hear phrases like, well, I think you should rotate into Europe because Europe's cheaper than the U.S. Well, that's a true statement. Where's Europe at? Europe here is this blue or aqua shaded line. Today, Europe is cheaper. Where is Europe? Europe's at 17.7. We were at 22.5. Yeah, Europe is cheaper. That's a fact. But it's always cheaper, folks. Don't fall for that bullshit. It's always cheaper. Why is it always cheaper? You're buying a different basket of goods if you buy European equities than if you buy U.S. equities. U.S. equities have a much higher percent of tech in the composition than the European indices do. So you're buying a different basket of goods. So just because it's cheaper today, don't get excited about it. Be smarter than that. So let's pull things together. Again, on a trailing basis, we were at 20, expensive. Forward PE was at 23. Oh shit, expensive. Now let's go to a longer term look. I just had the chart up there. I'll come back to it in a second. A longer term look. The problem with the first two charts I showed you, whether it's trailing PE or forward PE, is we're always looking at 1 year's worth of earnings. Again, the earnings for the last 12 months or what we think the earnings are going to be for the next 12 months. Suppose we opened up the window. Open up the window. We want to look at 10 years worth of earnings. Not the last year, but 10 years would probably give us a more accurate representation. What are we paying today, the price today, relative to average earnings for the last 10 years? All right, so that fixes our myopic problem, right? Our short-term problem of just focusing on 1 year. If we go to a 10-year look instead of 1 year, that fixes the problem. But it introduces another one. $1 worth of earnings 10 years ago isn't the same as $1 worth of earnings today. $1 of anything 10 years ago is not the same as $1 today, right? The difference is due to inflation. So what we have to do is we have to adjust the earnings for the last 10 years by the inflation rate, right? It's called cyclically adjusted PE, or the CAPE, cyclically adjusted PE. So the denominator now is going to be the average quarterly earnings for the last 10 years adjusted for inflation. Adjusted for inflation. Okay, so let's take a look at that. So notice first on this chart, we go all the way back to the 1900s. So we got 120 years of history here. Now, just recently, we hit a recent peak. It was in January of 2018. We hit a recent peak. And at that peak, we were actually more expensive than we were right before the Great Depression. Wow. We were just recently more expensive than we were right before the Great Depression. Now that's a statement. Now even as expensive as it was in January of 18, it was still nowhere close to the level of stupidity, the level of expensiveness, whatever you want to call it, of the dot-com bubble. December 99 was our all-time peak here. All right. We didn't get that stupid this time around, but we were at the second level of stupidness, I guess is the way to say it. Now, the other thing notice from this chart is notice that a recession doesn't start when valuations are at their extreme. Right? The 2001 recession, right, was a year and a half, 2 years after we peaked. So the fact that we're in a recession today and this valuation started rolling over in January of 18 is normal. It's normal. We're still expensive today, though, folks. We are still very expensive today. This 26, if you look back in history, right, just block off the whole bottom portion of this chart and look at the amount of times we've traded above this level. There haven't been many. There haven't been many. We are still very expensive. All right, so what are we supposed to do with this? We got, last week we had the Buffett measure that said things were nuts. We got a trailing PE measure that was very high, extremely high. If you think a trailing PE was at 20, which seemed high, but then when you think that no previous recessions that we traded above 15, then we get really concerned. Then we had our forward PE, much higher than anything we've ever seen. The forward PE was at 23. That was much higher than anything we've ever seen. And we got the CAPE, the cyclically adjusted. On all these measures, things are either crazy expensive or they're expensive. Now, occasionally you hear people say, well, don't worry about it. I know things are expensive. I know people are willing to pay ridiculous prices for equities right now, but don't worry about it because the Fed's pumping all the liquidity into the system, and that liquidity has to go somewhere. And right now, the outlet for all that liquidity is going into the stock market. So it's just a result of the Fed creating this free money environment. And that's supposed to be a justification for paying ridiculous prices for equities. Folks, do not fall for that line of shit. That is complete hooey. Your future, your retirement future, is more important than to buy in to that malarkey. It will not end well. It is true. It is true. The run-up in price we have is probably due in large part due to the Fed pumping huge amounts of liquidity in. But it will not last. It will not last. These ridiculous valuations will be corrected. And you want to adjust your risk profile ahead of time so you're not on the wrong end of that correction. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep.